I am. Thank you for the intro. I'm in New York City today, so you might hear a little bit of background noise and music, and sort of find a quiet place in Manhattan. But hopefully this will work. I'm full time in Palo Alto. I used to live in New York, and I now live in the Bay Area, where my partners and I run a venture capital firm. It's as you alluded to, a secondary firm, which you'll hear more about that strategy. But my background has been finance and legal roles at companies for about 20 years now in the Northeast and in the Bay Area. I spent 3 years at Lehman Brothers as a fixed income trader. I was in a group called Financial Engineering, which was a real exciting time to be on Wall Street. And then I was an econ major at Stanford and a law background at Harvard. And I was at PayPal for 10 years, where I met Dave McClure and Eric Jackson and others, but those are the two other panelists today. So had a long run at PayPal and was eventually running finance by 2010. Been a couple later stage CFO roles since then in the Northeast. One company that you might have heard of called Sonos, the consumer electronics company, now a public company on the Nasdaq, and now full time in the Bay Area in the venture space.
All right, Dave, how about you?
Sure. Thanks for having us today. I guess I'm born in West Virginia, so I'm a hillbilly here in California, but I've been out here for about 30 years or so. I went to school at Hopkins. My training's mostly in engineering, mathematics, computer science, but spent a few years in the Valley as a programmer, as an entrepreneur. Had a small company acquisition in the mid 90s, and then ended up working at PayPal with Aman and Eric and a bunch of other amazing folks. Had a few years there prior to the IPO, and then subsequently acquisition by eBay, and got to meet a lot of crazy, amazing people who went on to start LinkedIn and YouTube and Yelp and a bunch of other companies. So great country club to have been from. I started doing angel investing with a little bit of money we made from the PayPal IPO back around 2002. I guess started doing investing in 2003-04, mostly on the side as an amateur angel investor for the next 4 or 5 years, but got to invest in about 15 or 20 companies. Had a few big wins out of that. For folks who are familiar with SlideShare, Mint.com, and maybe a couple of others. And then I tried to start a fund in 2008, and the timing was a little bit off. That wasn't the best time to be starting a fund. So that didn't happen on the first effort, but got a great second backup option working with Peter Thiel and Sean Parker at Founders Fund for a couple of years before starting my first venture capital firm, 500 Startups. Along the way, I also got to invest in some really great companies with Founders Fund and with 500. Spent about the last 10, 12 years investing in literally thousands of companies, both here in Silicon Valley and around the world. My previous fund invested in about, 75 different countries, and we started funds in about 10, 15 different geographies around the world. So a little bit unusual for a Silicon Valley investment group. We did a lot of investing at the early stages, pre-seed and seed here in Silicon Valley, but also in many other geographies around the world. A few years back, started Practical Venture Capital, which is a bit of an inside joke because it's not so practical. And Aman and I joke about that a lot, but we have a good bit of experience investing in early stage. We've been applying that now to later stages and trying to find some angles on how we can capture venture style growth, but on a little bit faster liquidity horizon than traditional venture. I'll stop there.
Awesome. That's very, very interesting and impressive background. Eric, how about you?
Well, I'm also have hillbilly roots. So I'll back up Dave there, but fortunately I'm a generation removed. My parents were Virginians and did the Route 66 thing out here to California. But that's probably why Dave and I have always gotten along well together. When you're low class, birds of a feather flock together, something like that. I don't know, Dave. But anyway, it's a pleasure to be here today. My background, as Aman and Dave both mentioned, runs through PayPal. And that's formative for me moving into the tech industry. I was a Stanford student back in the 90s, studied economics, actually did research on entrepreneurship for my senior thesis, interestingly enough. But of course, sort of fell into the trap that that Stanford did for a lot of their undergraduates at the time, and pushed them into consulting and iBanking, and I wound up in the consulting trap for a little while. So I went to a really esteemed global firm that had 60,000 employees and offices all around the world. Had been in business for 100 years, and then about a year and a half later, jumped ship there to go to a little startup named Confinity. And knowing that that was around late 1999, usually you'd think, oh, that's a really bad idea, right? That was right at before the crash, the dot-com crash. And of course, then when I say the name of the two companies, the company I left was Arthur Andersen. The company that I joined would later be called PayPal. I suddenly sound a lot smarter than I actually am. So the timing worked out well there to leave kind of big traditional finance and financial services and move over into fintech. Of course, we'll be talking a bit about valuations and crashes. I think that's part of PayPal's story too, just the experience that it went through and what was born in. But to quickly bring the autobiographical portion of the panel to a close, at PayPal, I had a chance to do a lot of things I had no business being in charge of, including building our revenue model when we migrated from a free service to a paid one. There's a lot of funny things to say about that business model, but we'll save that for the question session of the panel. And then subsequently, just apparently was infected by the whole experience and decided I'd like to start companies. So I'm joining my VC friends here on this panel, kind of representing it from the tech entrepreneurs side. I have two companies actually today. One is called CapLinked. It's an online service for secure sharing for due diligence, virtual data rooms, and the like. And the other is a much more nascent company called TransitNet that we spun out of CapLinked. TransitNet is a blockchain adjacent company. We're building a title registry for crypto. So there's a lot that we could say about that, but I'll finish my biographical section with a plug. I decided to anoint myself as the historian of PayPal, and I wrote a book about the company's founding some years ago called The PayPal Wars. I think if you look really, really hard on eBay, you might find a dog-eared copy somewhere. It actually is going to come back out in print again later this year. So I have a new publisher that's going to bring that to print. But it was a story worth telling, and I guess I decided I'd make myself the scribe that would tell it. So hopefully we'll have a chance to share some stories from PayPal today.
Awesome. Well, I too am a fellow Virginian, so I guess we have three hillbillies on the call. So
Great.
Let's jump right in. So are the current valuations reasonable or unreasonable? There's been a valuation reset.
Yes, the answer is yes.
Okay.
Reasonable and unreasonable?
Yes, both.
Is this the right time to buy, or is there another shoe to drop?
Talking about like the public market valuation.
Public, yes.
Public markets. Okay.
Yes.
Mon, you
Yeah.
should jump in and start here.
Yeah, I can give you our, how we're seeing it or how we're thinking about it. I can share a screen here, correct?
Yep.
Okay, let me try that. So let me just take you through what's sort of driving a lot of the recent market expansion and where we think that leaves markets. Caveat: anytime somebody puts up a chart and says, here's how markets are moving and why, and here's a why the market's up or down today, and then takes a sip of like a $4 coffee or latte, just question that person. The news often reports this stuff in ways that aren't exactly right, and they attribute motives and recent events to they give credit to those things that that markets don't really deserve, because you're trying to predict a lot of different factors and random walks. That said, let me take a quick sip of my $4 latte and tell you why I think the market's moving, the way it is. So if you look at this chart, this shows two parallel lines. One is the size of the Federal Reserve balance sheet, essentially what the Fed owns, and the value of the securities it's holding. And then the other is the S&P 500, which is the orange line. And you can see what happened back in March of 2020. The S&P was in free fall, and the Fed basically very quickly began expanding its balance sheet and buying a whole bunch of securities, first treasuries, then mortgage-backed securities, and then they talked about buying even other risky assets, municipals, and the market immediately began to turn. And there's been about a 70% expansion in the Fed balance sheet and a 70% expansion in the S&P 500. And we think that is a huge driver of what's been taking valuations in the S&P higher. And over the past couple of months, the reset you suggested was just a function to like the Fed starting to walk that back and saying we're no longer going to do that anymore. We don't need to do that anymore. Arguably, we're way behind the curve on, on fighting inflation, on printing money and expanding our balance sheet. And so we're just going to start pulling that back beginning this month, February of 2022. And now they're talking about a rate hike in March. And I think that's also part of their tightening process. And the rate hikes are interesting, but really that Fed balance sheet is the most important thing that's happening. So who's gotten hit most as a result of the Fed walking it back? That green line is the Nasdaq. That's the tech-heavy US weighted index. They're down about 13% today from their all-time high. The next one is the S&P 500, which is about 7% off. And so those are the two, those two have been hit pretty hard by the Fed unwinding. The guys who have really been murdered are the small cap guys. The Russell 2000 is the next one down. That's a big basket of US publicly traded stocks that are much smaller than the Amazons, the Facebooks, and the Apples. But these are all 10 to $50 billion market cap companies. A lot of very exciting companies, a lot of high growth companies have just been hammered really hard by the Fed walking it back. So that's where I think there's been a lot of the pain and suffering. And I think where that leaves us, Dave and I, we debate this all the time. It's like, where do we sit now? Is it reasonable? Is it fair? Is it still too high? These are the two major indexes in the US. The one on the left is the Nasdaq Composite, which is, over half of that is tech, and the rest of it is largely consumer. So it's sort of a good tech proxy. And you can see the median forward PE multiple there over the last 10 years is about 21. And today we're sitting about 26, 25, maybe 24 based on forward earnings. So it's still a little bit high. It's definitely down from where it was a few months ago, still maybe a little bit on the high side. And so that, that probably means that I wouldn't be surprised if there's a little bit of a further drifting down, though I think the Fed signal did a good job signaling the rate hike. So I think most of it's priced in. And on the right, we've kind of gone back and looked at the S&P 500 over the last 4 economic expansions and just looked at the trailing PE ratio to their earnings. And today we're sitting around 35, 36. We began the expansion around a 30. So we've expanded some since. Historically, if you look at the last 3 expansions, we're mid-20s. So we're definitely still high, even today, still high on an historical side. And the reason is because rates are so low. You can see on the far right-hand side, the average treasury rate today it's 2%. About 6 months ago, it was 1%, which had never happened before. And in prior expansions, it's always been 2% or more. So if rates begin to drift higher, it's certainly reasonable, I think, that these valuations stay where they are, maybe come down a little bit. I'm not sure we've totally found the bottom yet, but I don't think we're far from fair value or for kind of a reasonable valuation now.
So how has this affected the private markets and the venture life cycle, like pre-seed?
Jeremy, before we jump out, I just want to kind of help summarize what Aman said. I think is because interest rates have gotten lower, faster growth companies' future earnings are less valuable than they used to be. And so that's one of the big reasons for the drop in value in the market, particularly under smaller companies with faster growth. And a lot of that does apply to tech. Is that a reasonable summary, Aman?
Yeah.
Okay. So yeah, with that said, how is that affecting the private market? These high growth tech companies, like how are you seeing that affect the private company valuations?
Maybe I can jump in a little bit here. So I think one of the things that we should try and understand is that venture valuations are supposedly not so directly linked to public markets, but they are linked to public markets on a time-related basis. And if you look at sort of late stage venture valuations and the investors who make those investments, they're pegging their valuations based on recent public company IPOs and recent public market valuations. And so what we tend to see happen is the late stage value investors will look at what's happening in the public markets, and they might change or reset their prices based on that. And then everybody sort of works their way backwards down the food chain to earlier investments. Now, some folks will immediately start changing their valuations, and a lot of venture capitalists will immediately start talking about cheaper valuations because it benefits them to invest at lower valuations.
Right.
But we may not really see that in private markets for two reasons. One is because if we are in a lower valuation environment, and probably relative to 3 to 6 months ago, I would say, yes, we are. It's going to take some time for those newer, investment valuations to sort of filter through the system. And the people who are raising capital don't really want to have to raise capital at lower prices. And so they will try and delay doing those new rounds as long as they can, as long as they have cash and or other methods of kind of continuing their business. They'll try to delay raising any money, and they'll also delay reporting about those rounds. And in a weird scenario, actually, most venture capital announcements that we see are probably delayed by 3 to 6 months, and in some cases may even be delayed by up to a year. Right. And so the valuations that we see reported right now in the venture capital environment are probably stale, right, and reflective of the previous environment 3 to 6 months ago that was a lot more expensive. So everybody may see the public markets kind of reset, and we may hear rumors about late stage venture investors, pulling term sheets or renegotiating deals. But then you see these huge announcements in the press of just crazy big numbers like we've been seeing for the last year, 2 years, 5 years. And people were like, well, wait, that doesn't seem to be reflected in the private market. And so that's really what's happening. There's a significant delay in probably people wanting to raise money in a lower valuation environment, and they'll try and, quote, grow into their valuations from last year as much as they can. Hopefully raise that money maybe 6 months, 12 months, 18 months out from now when they've gotten bigger, and maybe when, the environment's not quite as crappy as it might be at the moment. But they'll also be sort of like having these announcements ripple out that have happened, in 3 to 6 months ago when things were still a little bit more favorable. But behind the scenes, you can bet that those valuations are changing, particularly for the later stage folks who are, if you look at Insight and Coatue and SoftBank and Tiger, they've been writing a tremendous number of checks. Really, probably, most of those folks have been writing 100 or more investments in the past year. Some of them even 200 or 300 checks in the past year at $100 million or more, which is it's a crazy amount of capital to put into the market. And that's pretty new. That hadn't happened until maybe a couple of years ago. So people are speculating now that those, late stage investors who are really looking to make a return on their money within, say, a 2 or 3 year period, are they changing their prices, right? And the indications are that they probably are changing their prices. I think we would probably guess that they're down by maybe about a third, and possibly even more than a third, maybe up to 50%. Wow. If we look, and I'll hand it back to Aman to maybe talk. If we look at recent public market IPOs in the tech sector, they are probably down 30 to 50%, and in some cases more than 50% in the past year. Is that accurate, Aman?
Yeah, we were just I can just show this chart here on the left is a SaaS. We maintain. I knew somebody was going to ask me this question, so I figured, what, I'm going to pull the our proprietary index of SaaS recently IPO'd SaaS companies, and the multiples that they were getting in the public markets at the end of 2021. You can see in the left-hand chart was about 24, 25x sales. Now it's down to like 13x sales. So it's basically been cut in half. Exactly what Dave said. And exactly at Dave's point, the middle chart, I just went to PitchBook and looked at multiples over the last 9 years. And you can see that there have been 3, the Nasdaq, we call if the Nasdaq goes down by 20% or more, we call that a correction or a bear market. That has happened 66 times since 1971, FYI. So, over the last 50 years, it's happened 66 times. So about once a year. So this is not new, but we're experiencing. We haven't even hit a 20% correction yet, by the way, but we may. Those 3 gray shaded areas in the middle chart are where the Nasdaq corrected by 20% or more. So it's happened 3 times in the past 10 years. And each time, to Dave's point, the red line is where the private sector market valuations are. They, there was a little bit of a downturn at each of the grays, but it was delayed by about 3 months. And that's because stuff gets time to get renegotiated, stuff gets announced later. So a very small correction in each case, but it always came back. And on the right side is like the early stage, that's Series A, Series B growth stage. So not the pre-IPO stuff, but growth stage. that barely registered any blip at all. Even during these corrections, there's been, pretty steady progress on tech companies. So when we negotiate with entrepreneurs, I'll show them the one on the left saying, hey, your valuation is too high by 50% because the markets are corrected by 50%. And then they'll show me the one in the middle or the one on the right saying, no, we're still growing quickly. We're still a great company. We're still doing well. And then that's the negotiation where maybe the answer is somewhere in between.
Okay.
We just add a couple of anecdotal observations that back up some points that Dave made. In a recent conversation with several of our investors at my company, it came up the question of valuations, and these are typically doing earlier stage type investments, and they said that valuations in the U.S. have not come down, and they said it kind of begrudgingly, like, oh, we like
wish they had.
Yeah, wish they had, exactly. One of their investors did note that she was seeing investments in Europe that had come down a little bit more, but definitely not the case here in North America. So that notion of a lag and also a just maybe a delay in choosing to fundraise, a decision to sort of go to market later, or just be more choosy on the part of entrepreneurs. And again, speaking as an entrepreneur, as somebody who started multiple companies, I'll tell you this, that fundraising decisions can be driven by necessity, of course, depending on your burn rate and your runway. But there also is a sense of opportunism, that sense that, okay, if we, I don't need to go to market now in the sense that I, may have much more than 6 months of runway, but yet I might choose to, so I can, go raise at advantageous terms and move faster. So that is definitely a mechanic that goes into decision making for entrepreneurs. And to Dave's point, I think we have seen, or we're not seeing a precipitous drop in valuations at all. And I would just note one more thing, though. I mean, in kind of thinking about this question of valuations for private companies, particularly earlier stage companies, it's always something. It's always a bit nebulous, right? I mean, it's of course a couple steps removed from the public markets. So just the pricing of them, I think, is a little bit harder for that reason. But you've also had so many entrants into the market. I mean, Dave, Ramon, you were talking about Tiger. I mean, that's obviously a big name that's come in lately. But you've had so many come in at earlier stages that there's real competition to get into the good companies. And the proliferation of unicorns, I think, over the last decade has really just kind of brought that point home, right? I mean, the term unicorn's less than 10 years old. It was coined back in 2013, right? And
it used to mean a rare and magical mythical creature.
Right.
Now that there are 1,000 unicorns in the market, I'm not sure that definition matches as much as
we may need a new term.
Got to be the decacorn is the new unicorn.
I vote for wildebeest, but that hasn't really taken off. But that proliferation of just like 3 dozen so-called unicorns, when the term was coined a decade ago, to 1,000, as Dave notes, just shows you that, and you can quibble, like maybe that proves that valuations are inflated. Well, maybe it does, but even if those companies are overvalued by 10, 20, 30%, they're still really good companies. And the dynamic, I think, that's at play here, that I'm not going to say it insulates earlier stage investments from the public markets, but again, just moves it a few steps away and decreases the correlation a little bit, is that it's a binary outcome to get into these companies. And so with the money that's chasing these good companies, because again, even if they're a little overvalued, they're still good companies, you just want to get in. And so I think that dynamic has driven this investment in early stage, and probably made it a little less volatile, a little less connected to what we're seeing in the public markets.
So everybody.
And again, I would just summarize Eric's statements by saying he's correct that the further you are away from late stage valuation public markets, the less changes in the public markets influence early stage valuations. But for late stage venture, it is definitely pegged to come to the public markets. And so we're more likely to see face the music sort of changes in valuations, the closer those companies are to potentially going to an IPO. When they're really early stage and maybe 3 to 5 years or longer away from an IPO, it doesn't necessarily matter what the public market values are. It's more about the demand environment of people trying to compete to get into those companies. And what you'll hear people talk about is, valuations might be expensive, but we're just buying 1 or 2 years of forward growth, right? So if you're a venture investor who's looking at a 5-year or even longer return on their investment, it's maybe okay to get into great companies and pay an extra year or 2 worth of inflated valuation if those companies are growing fast and you're still going to get 3 or 4 years worth of growth. Maybe you're paying for 5 years of growth, but you're getting 3 years of growth.
So in short, what you guys are saying is investing in venture capital is very complex.
Well, I would say early stage investing is a lot more irrational than late stage investing. Late stage investing, those guys only have 1, 2, or 3 years to sort of let their irrational prices sort of match the market. And if they're wrong, they're going to lose a lot of money. Early stage investors, we're still betting on things going 10, 50, 100x. If we're paying a lot more than maybe what they're really worth, as long as they grow 50, 100x, we'll still make money.
So why are secondaries a better way for investors to play this VC market?
Good question. Well, let's start by saying, what do we mean when we say secondary?
Sure.
Because that might be a lot of different things.
Okay.
And actually, maybe I can sort of take a look at what we mean by showing you a chart. 1 second here. So the initial area that secondary started was probably about maybe 20, even 30 years back in the private equity market. If we look at those lighter green circles, we kind of pegging that to 2000, but it even started a little bit before that. The private equity secondary market started trading, maybe at small scale, $10 billion worth of trading 20 years ago. Now it's 100 billion. Actually, estimates are recently that it's maybe more like 120 or even 130 billion in the past year. So it's a pretty big market. Now, private equity itself is a much larger market, a couple trillion, maybe even 3 trillion. So we're not talking about huge percentages of that, but significant single-digit percentages of it are being traded. And a lot of that was stoked by the changes in public markets. So when the dot-com crash happened in 2000, when the global financial crisis happened in 2008, some other international changes maybe later, we saw activity start to get stimulated, and people who were investors in private equity who might have want to trade those positions. Initially, that was viewed as, maybe a desperate move or people selling, unliked portfolios. But as that market developed further and further, it became more just a natural liquidity function for people who wanted, an exit from a longer term illiquid, sort of position. So that became fairly large. If we look at venture capital, still some venture capital secondary trading was as early as 2000, but a lot of it became much more popular after 2005-10. And a lot of that, started happening again, maybe around 2008-9. Some of the companies that were more popularly traded were actually ones that were started by some folks we know. So Palantir was one of those, SpaceX was another. And originally, maybe that wasn't happening widely in the market. There were a small number of players who were doing secondary trading. Now we're talking about company shares, not necessarily funds. And that became a more popular sort of activity in the past, 3 to 5 years. So now, as Eric was talking about, the term unicorn started being popularized maybe 10 years ago. A lot of employees in private companies wanted liquidity for their shares, and maybe those companies took a little while to go public. In fact, in the current environment, they're taking even longer to go public, sometimes 10, 15 years or more. And so people wanted to be able to, buy a house in Silicon Valley, which are not always cheap. Maybe they wanted to hedge some of their bets, and right now 95% of my net worth is in my illiquid company stock options. Maybe I want to take a little risk off the table and get to some cash, or buy a house or send my kids to college. And so people started creating different ways to liquidate or sell those shares. And more recently, 3 to 5 years ago, we started seeing trading platforms for those, Forge and SharesPost, which have now merged. Carta is another one, and Equities is another company that we invested in as well. And there's just a bunch of people who have been doing trading in these not public shares, but they're often traded as if they were public shares. So that market has grown considerably in the last 10 years, and lots of people who aren't professional traders in venture capital are now also doing that. A lot of people talk about flipping unicorns. And that was a very popular activity that worked very well for people, maybe up until a couple of years ago. And now it's worked well for some folks, not always for others. And some people who bought privately traded shares in companies like Uber or Lyft may have bought them at prices that were actually higher than their public market offerings a few years later. And so it's not always been the case that people made money, quote, flipping unicorns, maybe similar to people buying condos in Miami, that the market doesn't always keep going up.
Right.
And sometimes when you get a little too close to the fire or a little too close to maybe the IPO, people are paying for brand names that are very popular. And companies like Stripe or maybe Airbnb and others before they've gone public are being traded at not a discount, but a premium to what their recent rounds were. So something I didn't mention is most of these secondary shares previously were trading at significant discounts to their recent financing, maybe 30% or more. That hasn't been the case recently. Now there's much more competition for those shares, and usually the discounts are not as significant. And in many cases, they might actually be trading at premiums because of demand.
Dave, I would just interject. Can I interject briefly?
Sure.
Just I want to highlight a point you made about companies going public much later and staying private much longer. Case in point, think of PayPal, right? It was
PayPal went public in less than 5 years.
Yes, much less than 5 years. And if you want to trace it back, I mean, there's different origin dates you could point to, but if you think about the launch of the consumer-facing software, which was sometime around like October, November of '99, and an IPO in February of '02, you're talking less than 2.5 years from product launch to going public. So that of course sounds ridiculous when you think about what companies are doing now. So I just wanted to note that to really highlight your point that you made about companies staying private longer and really also I think goes back to your other point from a few minutes ago about later stage companies being more closely tied to public valuations. It's because these companies are far more mature and stay private so much longer.
Absolutely correct. And the biggest change that I think we've seen in both public and private markets over the last 5 to 10 years is people recognizing that tech is all about growth and they're a great investment. The reason that we're seeing these companies stay private is because big investors have said, hey, why are we letting these great companies go public and letting everybody invest in them when they're such great growth engines? We should try and keep them private, take all of that opportunity ourselves. And whether you think he's crazy or not crazy, Masa-san at SoftBank put that to work with a $100 billion bet in their first fund. And maybe he didn't get it right with every part of that story, but for the large part, he's correct. A lot of these companies, the reason that unicorns became such a phenomenon was because we saw incredible results. A lot of the Nasdaq is fueled by venture capital invested companies that have gone public and have had tremendous growth post IPO. And so people were generally buying that post IPO performance and trying to take it private. And so the reason companies are staying private longer is because they can, and because they've been able to not have to deal with regulatory reporting environments, in some cases even get a better multiple on their performance from the private markets than they would from the public markets. And as Eric mentioned, a lot more people have entered private market investing over the past 5 to 10 years. Previously, public market investors are coming into the private markets, hedge funds, a lot of sovereign investors, a lot of family offices, a lot of corporate investors, a lot of international investors. So really, we've had tremendous growth in the venture capital market and an expansion of later stage capital because all of these tech companies were having great public market performance, and people were like, hey, we're just going to buy all that performance and take it private. And there's been a competition for those companies that has resulted in very favorable multiples for those companies' prices in the private markets. However, the big difference between those companies in the private market and public market is you don't really know what's happening with those companies. So you don't have quarterly statements, and you don't have, their CFOs publicly reporting their results or talking about guidance. You might hear rumors in the market. Some of those companies might talk about their performance, but a lot of times they don't. And so you just have to interpret how things are going. And maybe if you have access to some of the private market valuations, maybe if you know some of the people running the companies, you might have some visibility into what's going on. But for the most part, people are buying, those stocks, those private stocks, without a lot of transparency. And that's kind of a risky game. Okay, so I've been a long-winded explanation of where we are with secondaries. Now let's talk a little bit about venture capital fund secondary. If you look back at our chart here, most of the growth in venture capital secondary has been at the company level, more than 80% of it. Funds are less than 20%, and that started to grow more recently. But there's kind of a difference between looking at company secondary and fund secondary. Company secondary, you're looking at one company, and again, you might not have a lot of information, but you only have one problem to figure out: what's that company worth? When you're buying a fund, you have to kind of figure out what everything in that fund is worth. And some of these funds might start out with 30 or 40 companies. Maybe by the time we're looking at buying fund secondary, it might be a little further along, but there's still probably 3 to 5 companies, maybe more, that you're taking a look at. And so that's kind of what we have been focused on at Practical Venture Capital. The graph that I'm showing you now is the trajectory of venture capital fund over maybe 10 to 15 years. Those first few years, maybe 3, 4, 5 years, it's a bit of a roller coaster. You don't really know how things are going to go. Most of your bets probably aren't going to work. The ones that do work are probably still small in the beginning. But after maybe about 5 years, you might see some of those companies kind of get to a level of performance where they're more predictable and they're on a growth path that might result in an IPO or an exit. So as companies move from, say, seed stage bets to Series A bets to Series B bets, and maybe 1 out of 3, 1 out of 4 companies makes that jump at each of those levels. By the time you get to Series B or C, these companies now might be making 10, 20, $30 million in revenue, might be valued at a couple $100 million. Those companies are maybe less likely to just disappear or fail. They may continue scaling their growth, they may not, but they're not going to be as likely to fail as in the beginning. So that first 5 years, usually we don't really know what's happening as much. There's rarely any money returned to investors. But after 5 years, maybe after 5, 6, 7 years, you might know whether those funds are working, might have an idea about 2 or 3 of the companies that are starting to get some traction and get some customers. And then you might say, well, this portfolio looks like it's going to work, or maybe it's not going to work, but I start to have a feel for whether it's going to turn into something big or not. And that's what we think is the most interesting part about venture. That's why people buy venture, is that incredible scale and growth that we see those companies go on, often 50 to 100% per year type of growth or more. So that would be a great time to buy these funds, except one problem: most of them aren't for sale. Most of them are only offered to really experienced investors, endowments, foundations. You're not going to be able to buy Sequoia's funds, half off. They're generally not on the table. But there is a secret angle here, which is smaller funds, which are usually invested by smaller investors. Some of them might decide to sell. They're maybe not as patient investors as kind of the larger institutional folks, either the LPs or the funds. And so that's kind of where we're coming in, is saying, hey, we're going to skip this period of sort of maybe questionable roller coaster sort of area of risk. And we're going to start to try and find people who might be willing to sell a little bit early, probably at around year 5, 6, 7. And guess what? That's also when these funds are starting to distribute capital back to their investors. So we're not waiting 5 to 7 years before any dollars come back. Probably we're going to see our returns come back in just a few years.
Wow, that's great. That was a great explanation. So all 3 of you guys worked at PayPal. What were some of the lessons that were learned working at a unicorn during a downturn that can be applied to today?
Don't go public in the early 2000 period, I guess. Well, or late 90s. I think PayPal was one of the very first companies that went public after the dot-com crash, February 14th, actually almost 20
The,
years ago.
yes, yeah, the first.com.
Valentine's
Actually,
Day. Okay.
Yeah.
Yeah, Valentine's Day 2002, so a little over 20 years ago.
God,
Last
really
week.
dating yourself.
yeah, you
was-
guys have
Um,
aged. You guys have aged quite a
I
lot.
don't know what you're talking about. I
Still
have a
look great.
full head of hair.
Still look great. I do remember that period. I joined probably in late 2001, and we were working on the S1 and trying to get the company public. And then, you know, all the stuff changed. The market was really volatile then, and there was a good lesson about running out of money. And as a now I'm a CFO who's, you know, trying to advise companies to do this now, and I see how they spend, and they can. I think Eric said, like, or Dave said too, you know, if you don't, you know, you have an ability to delay when you raise based on your business. When you need to raise, you can dial in how much you're spending on different areas, and you can be very disciplined, and or you can raise a bunch of money and you can just blow it on, you know, on half-baked marketing programs and expensive real estate in the Bay Area and stuff like this. And
Or buying other companies.
yeah, even better. And, you know, PayPal in 2000 was raising a ton of money. Sequoia was one of our big backers, could do no wrong, and it looked like it had a big runway. And then magically, it was in March of 2000 that they raised the last big round, just as the market was tanking, and that was very fortunate.
Just before.
Just before, right? It was probably as the market was tanking.
Weeks,
Right.
matter of weeks.
Wow.
The check cleared.
Well-
you know, we were fortunate to be maybe the last major .com to raise before the
Amon, you're
IPO.
understating it, right? If
Go ahead.
for younger, you know, if you're younger and you're on this, you know, on this call, you might not remember what it was, what you're talking about, right? The Nasdaq dropped what 40% in
Oh,
just
yeah.
a matter of weeks, right? From 5,000 to 3,000,
Yeah.
roughly. So that makes today, you know, the volatility of
And
2022
companies-
look.
Yeah, individual companies dropped in value by considerably more in
Oh,
many
yeah.
cases.
If they made it
Sometimes
all.
90 to 100% of their value was lost.
Wow.
That was a
So
big
it was-
shakeout. A lot of our competitors just didn't make it, period. Like their valuation went to zero. We had probably 8 different payment competitors all vying for space in our
Mhm.
on our platform. I think by the time it was done, they were either owned by Yahoo, had been, you know, bought, sold, and eliminated, or they were just, you know, they were basically shopping themselves to us and others. So by the time we kind of got through that nuclear winter, we were one of the few survivors. But I remember how tight we were with managing.
You say nuclear winter like there was only one. That was actually more like, you know,
the first
3, 4, 5 years for many
Right.
companies.
Yes.
Right.
The you know, I'd add to sort of build on top of that. He says as he sips his $6 cold brew,
Yeah, you're like really in touch with financial.
$4
$4
latte.
now.
Who's the cheapskate that gets the $4 latte? But I think in some sense that downturn actually made PayPal stronger, and I think this could be true for a lot of good companies going through tough times. We were forced to improve a lot of things. We were forced to make our business model better. We were forced to actually create a business model. So
Yeah.
there was, you know, there were little things like that actually were pretty meaningful for us during that time. I mean, when the company was launched and was originally scaling, we were paying people $10 to sign up and $10 to refer a friend, and we were assuming that we could just offer the service for free in perpetuity and make money off the float, right? And interest rates were what, 7% or something back in 2000. So that idea that all the money would just stay inside of PayPal and
Right.
recirculate, and we just enjoy the float, was completely wrong. The interest rates, of course, had to go the other way right after the crash. And then more importantly, though, it turned out people didn't just keep large amounts of money in PayPal. They'd use it to buy stuff. So they'd bring it in with a credit card. Yeah, there'd be a fee associated with the
People
funding that
buying
would come in.
things.
Yep. And then a merchant that received it, you know, decided like, oh, I'm actually going to take that out and maybe use that money on payroll or rent. So the business model was totally broken. We had to actually build a business model. We moved to a transactional model and migrated our merchants to pay, cut our marketing expenses, and did all those things that we needed to do in order to survive and adapt to the market. So I think big picture, you could argue that the tougher market forced us to make the decisions we needed to build a viable business faster.
Yeah. For sure.
And in some sense, helped. And if you're a good company, you can weather a tough market. You can improve from it. It helped with recruiting. It actually was probably easier to attract and retain talent during that time. And I think all the impressive list of alumni and all the things they've done since then, I think it bears proof of that. So I would just add that point about going through tough times can actually help an early stage company grow up, go faster, and be more responsible and build a good long-term business.
Yeah,
Right.
I think adversity helps. I think Nietzsche said it best: what doesn't kill you makes you stronger. I'm not sure that's exactly right. I think what doesn't kill you might also leave you, crippled and weakened for the rest of your life. But conceptually, adversity is a harsh teacher. And yeah, I was looking it up that during that period, the Nasdaq fell 77% from March to October 2000. So that was, take what's going on today as the 13% drop in whatever pain's being felt, like the 77%. And a lot of the companies didn't make it and couldn't hire. So we were one of the survivors, and we had to redo our, get to profitability because otherwise we wouldn't get public. It was, there were a lot of lessons during that period that I've carried with me for the rest of my life.
Yeah, and I guess I would say, maybe looking at those, not just that one crash period, but also 2008 and 9, and maybe even more recently, the mini crash back around March, April 2020 with COVID. There are some significant differences about what's happening in the market. So, the primary factor that was happening in the late 90s, early 2000s was a lot of companies weren't really companies. And in many cases, they not only were they not profitable, they didn't have revenue. And so a lot of those stories that people took public lost the money on because they weren't real. If you contrast that with maybe 2008-9 period, that was not a market blow up in tech, that was a market blow up in mortgage finance, and it bled over into tech and other categories. But fundamentally, those companies were actually, pretty solid and growing. And in many cases, you could really buy some great value and great growth actually by investing in those companies. When I started investing at Founders Fund, it was exactly during that time frame. This is 2008, 9, 10. I got to invest a small amount of capital that Peter and Sean had raised, only about 2 million, 2.5 million. But we invested in about 30 or 40 companies in 2008, 9. We ended up returning 200 million on that. Wow. 2.5 million. And we got into companies like Twilio and SendGrid and Credit Karma and Lyft and others that had 50 to 100x returns. So not only did we see 50 to 100x growth, but we saw a really great low valuation environment. And if we look at today, again, I think the same sort of things are going on, but the valuation environment maybe has been a little bit inflated. So the underlying companies, I think there's great businesses being built and lots of entrepreneurship going on, tons of opportunity. And generally what we've seen is a lot of fast growth. There's still a lot of failure and there's still a lot of risk. But overall, if you're investing for the longer term, say, 5 to 10 years, you're investing in companies that have potential to grow 100x or more, in some cases, even 1,000x. But at the same time, there's so much competition for capital. It's a lot more expensive to invest in those companies than it was maybe 10 years ago when there weren't as many people jumping in. So I think you have to sort of balance those two stories, which is, what kind of valuation environment are we in, and are we paying too much or not too much for those companies' growth opportunities? And yet, are we also taking advantage of venture and tech and growth that does have that big potential? And a lot of times people want to play that safe by investing in well-known names that are close to IPOs. But as we kind of saw, that's actually kind of the most risky area, because if you're in a high valuation environment, you don't have a lot of time to grow before you have to face the music of public market valuations. Whereas if you're looking at earlier stage companies, maybe you have a lot more time to sort of see that compounding growth, but you have to kind of balance that between the time it's going to take for those companies to get to liquidity.
So we have about 8 minutes left. So how is what we're seeing right now in the venture space similar to what we've seen in like real estate or private equity asset classes before?
It's like the secondary shift.
Yeah, and the downturns.
Well, definitely the secondary market provides liquidity to a market that previously wasn't very liquid, right? And so we've seen, secondary markets develop in private equity, in venture capital company shares, and now we're seeing it develop in venture capital fund shares. The recent dynamics in the market probably mean that, the public market's probably been overvalued, at least a little bit, maybe even a lot for some companies. So we're probably discounting public valuations by maybe a third. In private markets, as those companies get a little bit later stage, we're probably looking at discounting by a third, but maybe in the earlier stages, we're not. We're still just buying growth, and we're buying that as much as we can. So in a way, we think that the secondary market in venture capital funds is kind of a good compromise between that, sort of not overpaying for value, and in many cases, even getting it at a discount, but still getting 3 to 5 years of compounding growth, hopefully at 30% to 50% or more over that period of time.
Yeah, we saw that happen with real estate in the late 80s to early 90s. The financing for real estate kind of went from money center banks to mortgage-backed securities. And so the holding periods for real estate changed, and there was demand for liquidity. And so there was a market created in the late 90s. I think in venture capital, in private equity, we saw this in the mid to late 2000s, and really exploded around that 2008, 2009 market freeze up. Investors needed liquidity, and so we had buyers. And initially there was like period of deep discounts, focused on distressed assets, and then kind of a stigma. Like, why are you selling if you're in such a good investment, Mr. Private Equity? If you own shares in Palantir, why would you sell? What's wrong? What's wrong with Palantir? Why am I buying? And so I'm very nervous about these conflicts of interest, and I'm nervous about the stigma. I don't want founders to sell. If a founder wants to sell me, shares of his company, that's got to be a bad signal, right? Like that's got to be the mark of Cain. But I think at some point around 2010, 11, 12, just the holding periods began getting longer. There were legitimate reasons for people who wanted to sell. So it became like an accepted market practice probably around 2012. I remember at Sonos, we did a secondary trade to KKR, who came in and they swooped up and they bought out a lot of our early employees. We'd been private for 11 years at that point. So a lot longer than the PayPal, Amazon, eBay, Yahoo example, where they were all public within 3 to 4 or 5 years. And my COO wanted to sell, and he was like, I want to buy a house in Santa Barbara where I live, and I want to buy my wife a car, because otherwise she's going to leave me. And so if I can't do those things, like, I'm not taking advantage of anybody. I just want a fair price for my shares. So I helped negotiate the sale of a number of employees to KKR at a discount to value, but it was fair price, and I think the stigma was going away. And even a couple of years ago, I think venture was still a very small secondary space where there's still a stigma. Why are people selling? GP, conflicts of interest, and now I think we're seeing broader market acceptance. The good news is we're early in it, so I think we're getting good deals and good discounts. But I imagine over the next 5 years, it'll become much more liquid. The discounts will probably get bid away. Transparency will increase, and we'll follow the same patterns we saw with the real estate asset class and the private equity asset class for the next 5 years.
With companies staying private for a decade or more, that ability to have some stakeholders get liquidity is critical, right? I mean, how can you align incentives otherwise? And that idea that as an entrepreneur, I can say personally that the idea that you would sort of chain the founding team to the company and say sink or swim, after going for a decade or more and not have a chance to get some sort of liquidity is a bit insane, right? It definitely skews incentives. So in some sense, the secondaries, I think when you step back and look at it, it's very healthy. And it is really encouraging that market has evolved over the last decade or so.
Yeah.
I think, again, the one thing that we would probably point out is that, as those markets develop, as they get more competitive, you see a lot of the advantages, maybe, arbitrage away. And in venture capital company secondary, it's a much more competitive market and maybe not as much of a bargain as it used to be. In venture fund secondary, we think we're still in the early stages of that movie developing, and we feel like we have some advantages in being able to buy, at pretty substantial discounts to value. Hopefully that offsets some of the risk of the market being overpriced. And in addition to buying at a discount, we're buying companies that are just still growing in fast rates. Again, the companies themselves are growing at 50 to 100% per year or more. The portfolios that we're buying are growing at 30 to 50% per year. Normally, you wouldn't be able to find, someone wanting to sell an asset that's growing to 30 to 50% per year. The reason that there is because those people are looking to diversify out. They might have some financial needs. They're not necessarily the most patient or larger investors in more recognized institutional funds. They're folks who've been in those funds for 5-7 years or more, and they probably have some wins on the table. So they're selling something that's still a win for them that generates maybe a 2 to 3x return. But the underlying value might be significantly more than that. And probably more importantly is the forward growth is still quite substantial.
So we got 3 minutes left. How about everybody just kind of share their final thoughts on opportunities, your contact information, and then we'll head out.
Well, let me
Sounds great.
just, I had a thought I wanted to just jump in and share real quickly that Dave has a unique perspective as one of the great all-time angel investors, just in terms of number of companies he's invested in, not just at founders, but also at 500 startups and your time as an individual investor too. And so I would just say like that concept of being able to find companies that are de-risked, that have made some progress, that have survived for a couple of years, and then getting them at a discount is, I think, ridiculously exciting. So I would just note that point, because those first couple of years are the hardest building a company, and for companies that are growing and survive that and growing, I mean, if you can get them at a reasonable price, that's going to be a good bet, because this proliferation of unicorns or decacorns or wildebeests is it's not going away. So finding a good, finding a way.
I saw you.
Look, when the phrase "software is eating the world" was coined by Andreessen, was that a decade ago? It was a bit prescriptive, and now it's obviously descriptive. So I think that's where we are today. So I just wanted to echo Dave's point and say I completely agree with that.
Yeah, I think I'm excited about the this kind of alternative asset class in general and VC in particular. I think the recent market volatility it's good. It's a healthy reset of valuations and prices. It's like good stuff. When good stuff goes on sale, I'm a happy camper. When good stuff goes through the roof, that's when I don't really want to go shopping, because it's like everyone else like bidding up all the stuff that I want to be getting a bargain on. So I'm kind of a cheap guy. So I like the fact that valuations are down 10 to 20%, but we're not in a recession. The economy is growing. Unemployment is at 3.8%, which is essentially full employment. Everyone who wants a job has a job, probably has 2 jobs and is getting offered a third. So the stuff that consumer spending is growing, GDP per capita is almost back to trend. Like we lost some output around March 2020 in terms of the US and Western economies. We've made it up a little bit ever since. We're almost back to trend. So the companies are performing well. They're as profitable. Our tech sector is as profitable here in the US as it's ever been, certainly more than in 2000. So it's fundamentally performing well. And as long as that's the case, I think getting in at, as valuations ease up a little bit is really good for long-term investors. So I'm really excited about the next 5 to 10 years.
I think we're in an environment now where we need to pay attention to the fact that inflation is going to start eating into the investments values that we're buying. And so, for us, we're really still looking at tech as a growth engine. And if, we are entering a period where inflation is starting to get to 5 to 10%, potentially even higher, we'd like to offset that risk by buying companies that have the potential for a lot of growth. And maybe we don't want to go quite as early as the early stages where there's a lot of risk of them dying. We want to kind of buy them, portfolios where the companies are maybe between a couple $100 million to a couple billion in value and still growing at 50 to 100% per year or more. That's a pretty reasonable compromise between risk and growth. And again, because we're looking at buying these, through a little bit more complex mechanism than the average investor has access to, we're getting in at some substantial discounts to value that offset the risk of the rest of the market being a little bit overpriced.
Well, thank you, gentlemen. This has been great, very educational. You have your contact on the screen you did a second ago, but if people want to contact you, you can contact me, Jeremy at Flyer, and I'll pass it on, and it's back on the screen. All 3 emails are up there. If you don't get it, just let me know. I'll make sure to connect you. Thank you, everyone, for joining us today. This has been a great chat, and everyone
Thanks
have a
a lot,
good
Jerry.
day. Thank you.
All right, take care.
Bye.